My name is Michael Grandy, and I'm a professor at Providence College. I'm going to walk through a problem from the managerial accounting textbook. This is problem 23-3A. It's Rudd Clothier, and this is a variance analysis problem. This is on page 1159 of the text, and I would strongly suggest that you have two things in front of you at this point. You have the solution, which I've provided to you on Sakai, and secondly have the problem in front of you. It's important for you to be able to trace the problem into the solution and follow along with the solution. So Rudd Clothier is a small company that manufactures tall men's suits. The company has used a standard cost accounting system. In May 2017, 11,250 suits were produced. That's the actual output. That's an important number when you're calculating the standard quantity. So the actual output is 11,250 suits. The way you know that is the wording. It says, again, in May 2017, 11,250 suits were produced. Past tense. The following standard and actual cost data apply to the month of May, when normal capacity was 14,000 direct labor hours. All materials purchased were used. So the section that you now see on the chart is direct materials, direct labor, and overhead, and they provide you with the standard information, both quantity and price, and then they provide you with the actual information. It goes on to say overhead is applied on the basis of direct labor hours at normal capacity. Budgeted fixed overhead costs were $49,000 and budgeted variable overhead was $36,400. Please remember, the budgeted information is used to calculate predetermined overhead rates, and the predetermined overhead rate is the standard price. So what I'd like to do first is to prepare the standard cost card. And a little more room for myself here. And as you recall, the standard cost card is a summary of the quantity and price standards, assumptions for direct materials, direct labor, and overhead. So I'm going to have quantity, price, and total. And we're going to look at direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. Now, a lot of this information can be found in the problem itself, and for direct materials it says 8 yards of material per suit, and that is at a price of $4.40 per yard for a total of $35.20 per unit. Direct labor, it says it takes 1.2 hours to make a suit, and the labor rate is $13.40 per hour for a total of $16.08. It goes on to say that overhead is applied on the basis of direct labor hours, and the first thing we want to do is come up with the predetermined overhead rates. And that's an important thing to do because you're going to have to figure it out. Please remember, the predetermined overhead rate equals total estimated cost divided by estimated hours. In our example, they give us the budgeted information at the bottom of the problem, and they also tell us that the budgeted Direct labor hours is 14,000 hours, direct labor hours, normal capacity. So I'm going to calculate a predetermined overhead rate for variable, a predetermined overhead rate for fixed, and predetermined overhead rate for total manufacturing overhead. So the numbers that are provided to us, again, the bottom of the problem says at normal capacity, budgeted fixed overhead costs are $49,000. So for the fixed, we've got $49,000 divided by the 14,000 hours, and that's going to equal $3.50. That happens to be the predetermined overhead rate is the standard price for fixed overhead. We'll put that number right over here. And since manufacturing overhead is applied on the basis of direct labor hours, we're going to continue to use that same 1.2 hours per unit. Let's take a look at the variable predetermined overhead rate. And again, the problem says, and budgeted variable overhead was $36,400. So I've got $36,400 as the numerator. The denominator continues to be the 14,000 direct labor hours. And the predetermined overhead rate for variable is $2.60 per hour. So that number is going over here, $2.60 per hour. Still 1.2 hours. So now we can finish off our total predetermined overhead rate. So what I'm going to do there is add both the budgeted variable and the budgeted fixed to come up with $85,400 divided by the same 14,000 hours, and that's going to be a total of $6.10. So you want to be able to calculate the predetermined overhead rate for variable, the predetermined overhead rate for fixed, and the total predetermined overhead rate. We can finish our chart, our standard cost card, and 1.2 hours at $2.60 per hour. We have $3.12, and fixed overhead is 1.2 hours at $3.50, $4.20 per unit. So the total cost per unit is going to be $58.60. Standard cost card is a summary of all standards, materials, labor, variable overhead, and fixed overhead. It's a good summary, so when you begin to calculate your variances, this information is all there for you. So we're going to erase that, and we're going to begin taking a look at our variances. And you know we are using the format of AQ times AP, and this is the actual cost. And on the far right hand side, we're looking at the standard, which is SQ times SP, and in the middle we have another number which helps us isolate both the price and the quantity variance. It's AQ times SP. And we're first going to look at direct material variances, and I like to start with the standard quantity because that's the most difficult number to come up with oftentimes. And you first want to look for the actual output. And again, going back to the problem, Third sentence, in May 2017, 11,250 suits were produced. So that's my actual output. 11,250 suits. And we're looking at the direct materials variances. So we need to consult the standard cost card and see what the quantity should have been per suit. And the quantity is 8 yards per suit. The SQ, they should have used 90,000 yards of material to make those 11,250 suits. And the standard price, again from the standard cost card, is $4.40. That is per yard, for a total of $396,000 is what they should have spent to make those 11,250 suits. Let's look at the actual cost. And again, we're referring to the problem, and they tell us the actual cost was $375,575, which is made up of the actual quantity of yards. They actually use 90,500 yards, and they told us $4.15 per yard. So here we can see the overall variance, the difference between what they should have paid of $396,000 and $375,000. They have a variance of $20,425. They spent less than the standard. This is going to be a favorable variance. But again, we want to isolate it. We want to find the price, and we want to find the quantity variance. So the first thing we're going to do is jump in the middle here and fill in AQ and AP. The AQ is the actual quantity, 90,500 yards, and the standard price, $4.40. This number here is $398,200. And that's going to show us a price variance of $22,625, and that's going to be favorable because the standard was $4.40. They actually paid $4.15. That is a 25-cent per yard savings over 90,500 yards. That is $22,625 favorable variance. So here I would say, good job purchasing. That is someone should be accommodated, somebody should be congratulated on that situation. Let's take a look at the quantity variance. And when we look at this, we see that the quantity variance works out to be $2,200 unfavorable. And the reason that is unfavorable is that they should have used 90,000 yards of material. They actually used 90,500 yards of material. They used too much material. They used 500 yards too much at $4.40, $2,200 unfavorable variance. And what that means is that they used too much. Used too much material. The recommendation for action would be there, possibly do some job training so that workers are not using too much material, wasting too much material. But on the other hand, with regard to the price variance, that person who's responsible for purchasing should be congratulated on a job well done. That is the direct material variances. Let's take a look at direct labor. Let's get ourselves a little bit more room here. It's a little too tight. Again, we're looking at actual cost, which is AQ times AP. We have the standard, which is SQ times SP, and in the middle we have AQ times SP for the purposes of isolating the variance for quantity and price. So again, these are the direct labor variances. We're looking at rate and efficiency. And again, going back to the problem, they produced, their actual output was 11,250 suits. Again, this is actual output. Actual output in units, specifically suits. And the standard is 1.2 hours per suit. They should have used 13,500 hours to produce those suits. And if we look at the standard cost card again, we're looking for the standard price, the labor rate, which is $13.40 per hour. They should have spent $180,900 to make those 11,250 suits. What about the actual? So again, looking at the problem, they said they spent a total of $200,925, which was made up of 14,250 hours of actual hours, and they paid their employees $14.10 per hour. They have an overall variance of $20,025. This is our overall variance, and this is unfavorable. They should have spent $180,900. They actually spent $200,925, $20,000 more than they should have to produce those 11,250 suits. And again, we want to focus in the middle here so we can isolate the rate and efficiency variance. And AQ was 14,250 hours. SP, $13.40 per hour, for a total of $398. I'm sorry. For a total of $190,950, resulting in a rate variance. This is my rate variance here of $99.75, and that's going to be unfavorable, $9,975. It's unfavorable because they should have paid them $13.40 an hour. They actually paid them $14.10 an hour, 70-cent per hour difference over $14,250. Unfavorable variance. So I would say here that they paid too much per hour. Over here we have our efficiency variance, and our efficiency variance works out to be 10,050, and again that is an unfavorable variance. It's unfavorable because they should have used 13,500 hours. They actually used 14,250 hours. They used 750 hours too much at $13.40. $10,050 unfavorable variance. They are not efficient. And again, I would suggest that they probably need some job training to correct the situation. They need to be more efficient. This is a very high variance here. This variance is more than 10% of what it should have been. $20,000 divided by $180,000 is more than 10%. That's an extremely high variance. They need to do two things: job training to make their employees more efficient, and they need to bring down the pay, which is difficult to do, but they're paying them too much. Those are the direct labor variances. At this point, we want to take a look at the variable manufacturing overhead variances. And again, please remember the predetermined overhead rate is the standard price. And let's go to the information that they provide us with. And again, let's start with the standard quantity. And again, they produced 11,250 suits. Manufacturing overhead is applied on the basis of direct labor hours, and we know it should have taken 1.2 hours per suit. They should have used 13,500 hours, but we saw that calculation in the direct labor variances. The standard price, the predetermined overhead rate for variable overhead, is $2.60 per hour. They should have spent $35,100 on variable overhead. What did they actually spend? Well, again, we look at the problem, and they told us that they spent $37,000 on variable overhead, and their actual hours again were 14,250. They spent more than they should have spent. They spent $1,900 more than they should have. That's an unfavorable variance. That's an unfavorable overall variance. And again, we're interested in the middle number. And what we find here is the actual quantity was 14,250 hours. Standard price, $2.60 per hour. This middle number is $37,050. We have a rate variance of $50, which is favorable. And we have an efficiency variance here of 1,950, which again is unfavorable because they should have used 13,500 hours. They actually used 14,250, is therefore unfavorable. All this variance does is supports, once again, that they are not efficient. let's move on to, and again, this was what? This was variable manufacturing overhead. Those are the variable manufacturing overhead variances. What we want to do now is look at the fixed overhead. And what's important to realize here when we are talking about fixed manufacturing overhead, that the middle number is budget. It's not AQ times AP. So we're going to solve SQ the same way we've been solving it in all the other variances. 11,250 suits times 1.2 hours per suit. Again, they should have used 13,500 hours. The standard price, please recall, the standard price is the predetermined overhead. In this case, it's $3.50 per hour for a total of $47,250. That's what they should have paid in fixed overhead. Looking at the problem, we see that they actually paid $49,000 in fixed overhead. And now we want to look at the budget. And the budget number, again, we use that as the numerator in calculating the predetermined overhead rate, and we came up with $49,000. They told us that budgeted fixed manufacturing overhead was $49,000. Overall variance was $1,750, and this is unfavorable. These two numbers here, the actual versus the budget, produces the budget variance, which you can see is 0. They budgeted $49,000, it was actually $49,000. There's a 0 variance there. The difference between these two numbers here, this is our volume variance. And the volume variance shows that there is $1,750 unfavorable variance. So those are the fixed manufacturing overhead variances. What I want to do now is talk about this volume variance, $1,750 unfavorable variance. In order to understand this, we got to look at budgeted volume versus actual volume. And when we talk about volume, we're talking about the number of units sold. In this case, the number of suits that are sold. And specifically, we are looking for two numbers. We are looking for budgeted volume, and we want to compare it to actual volume. Again, the volume is the number of suits. So, at the beginning of the problem and throughout the problem, we learned that they actually produced 11,250 suits. But the question is, how many suits did they budget? They don't tell us anywhere in the problem the number of suits they budgeted. But they do tell us a couple of things. They do tell us the number of hours that they budgeted. Again, at the beginning of the problem, they told us the following standard and actual cost data applied to the month of May when normal capacity was 14,000 direct labor hours. And again, at the end of the problem, they said at normal capacity, Budgeted fixed overhead costs were $49,000. Budgeted variable overhead was $36,400. So what we did at the beginning of the problem is we calculated the predetermined overhead rates using 14,000 hours as the denominator value, as the activity base. So we have to ask ourselves, how did they come up with total direct labor hours? So total direct labor hours, and this is total budgeted, right? Total budgeted direct labor hours, they had 14,000 hours. How did they get that? Well, the first question the company had to ask themselves is, how many units did they expect to produce and sell? And then they multiplied it times 1.2 hours per unit, per suit. So if we know two of these numbers, we can find the third one. We know the total direct labor hours. We know it takes 1.2 hours per suit. What we don't know is this number here, which is the budgeted production volume. But we can solve it. And the way we can solve it is we can take 14,000 hours divided by 1.2 hours per suit, and that comes out to be 11,667 suits. In essence, we put that number right here, 11,667. And the math works, doesn't it? 11,667 suits times 1.2 hours per suit equals 14,000 hours. That's how they came up with the 14,000 hours, because they started with this number, 11,667. Budgeted volume, 11,667. In other words, they expected to produce 11,667 suits. They actually produced only 11,250 suits. They came up short, right? $417 suits. They budgeted 11,667. They only produced 11,250 suits. They came up short 417 suits. Therefore, unfavorable volume variance. They came up short. Who would you blame? Who takes the fault? I would suggest that the salesperson